Hi, I'm Michael Gable, Managing Director at Fairmont Equities. Sometimes the biggest opportunities in share markets is when you get these large rotations from one sector to another. The commodity sector at the moment is extremely unloved, but we have to remember that commodities are cyclical. So you want to be buying these when you're at the bottom of the cycle and no one wants them anymore. I think at this point in time, we'd be looking at a case of when, not if, commodities start to rally hard again. Commodities are so unloved that they are extremely cheap. The best way to illustrate this is to look at their valuations compared to the rest of the market. So this chart is looking at commodities as a ratio to the S&P 500. So as we could see, since 1970, we're basically scraping the lower ends of that ratio. And here is a very similar chart, but constructed as a ratio to the Dow Jones. And this one goes back to 1900. Again, we could see that they're at record low valuations, very similar to what we saw in the late 60s, early 70s, before the massive rally in commodity stocks. Hedge fund positioning in commodities is so low that the net result is that hedge funds are short commodities. This is the far right-hand side of this chart. This means that we're not looking at a crowded trade where everybody is already in it. We have a situation where no one's in there yet. So when the hedge funds start to move into commodities again, they'll have to buy back the stocks to cover their shorts, and then they'll have to buy a lot more to get representative exposure. And this, of course, will lead to a massive move higher. Hedge fund positioning is as low as it was at the start of 2016. So that's at the far left-hand side of this chart. And as we could see, they then had to adjust by buying commodities, and their exposures increased again to a more representative level. Now, this is the Materials Sector Index, which is an index of Australian mining stocks, as we could see going back to just before the GFC. Now, I've circled on the chart in the middle there the start of 2016, which is, as I said, equivalent hedge fund positioning now is the same as it was at the start of 2016. So you could see that the effect of the hedge fund buying was to cause a huge increase in the share prices of commodity stocks. We're at a very similar stage now. So now is the time to be positioning in this sector, because it's just a case of when, not if, we see a huge rally in commodities. If you're looking for more recommendations, go to fairmontequities.com and sign up for the free trial. You'll receive my trading guide on how I buy and sell shares, and you'll get 8 weeks of our research delivered to your inbox. And if you qualify for the portfolio management service and you have more than $500,000 to invest, give me a call and I'll explain how that works.